We're going to bring in Stephanie here. You said the Fed does need to fight inflation, but how much is too much? And might Chair Powell have been more right than wrong a year ago when he was using the word transitory on inflation?
No, I think he's totally wrong, Tyler, on transitory, right? I mean, we know that wages are going up huge. We know rents are going up big. Not to mention PPI at 9.8%, CPI at 7%. Maybe some of it comes back and down a little bit as we fix supply chains, but that's the reason that they have to actually raise rates. But I do think he's not an extreme person. He's data dependent, and I think he's watching all of this, including Ukraine as well, and they'll act accordingly. Everyone's saying, well, the market's going to do the job for them. I disagree. The market was up 27% last year. That's the S&P. The Nasdaq was up 21%. Okay, so fine. We're down a lot this year to date, but nowhere near as what we were up last year. So you've got to smooth average it through, and I think you have to look at the economic data. And post-Omicron, I believe you're going to see pent-up demand and a little bit better growth than what we're seeing now. Right now, we're getting distortions in the economic data because of Omicron. So let's see. And I think with higher inflation, a little higher inflation, a little higher growth, they can, in fact, raise rates and normalize policy.
Steve, react. Obviously, Stephanie's not buying my thought out there that maybe transitory is the word that might work here. If the Fed is so intent on raising interest rates, why don't they get about it and do it tomorrow?
It's a good question. I think the Fed is behind the curve. The reason why the Fed delayed is they didn't want to have a big reaction, certainly in the bond market or in the stock market. And I don't know if this is too much of a reaction for it. I suspect it's not. Look, what the story is that Stephanie had it right. The Fed is data dependent. And you could be right, Tyler, and I don't mean that to be too astonished by that fact, but you could be right, Tyler, that inflation ends up being at least more transitory than is built in. There are people out there who think that in the next 3 or 4 months we could see some decline as we get some of the supply chain problems. And also, by the way, as we make a shift from services to goods, we've spent an extra $1 trillion in this economy on goods purchases, and that has been a big part of the inflation issue we've had out there. People start going out and spending more on services, take some of the pressure off the goods inflation. That will help. But then the Fed can react. The Fed has only penciled in 3 rate hikes and talked about balance sheet reduction. None of that has to happen. If you, for example, have inflation crater, the Fed can back off that in a heartbeat.
All right. Stephanie, stay right there. Steve, thank you. And we'll talk some earnings now. As stocks sell off on rate hikes, the real fear is those hikes would slow the economy, and in turn, that could hurt corporate earnings, which already have been showing some disappointment. Let's bring in Bob Pisani for more now. Bob?
And Kelly, the important thing is stocks are facing 2 headwinds. One is multiple compression, and the second is some potential earnings headwinds. Now, multiple compression is very important. The PE ratio, the multiple, is basically what investors are willing to pay for a future stream of earnings. And that's been going down. It's now below 20. It was as high as the mid-20s and even in the upper 20s a year ago and has been coming down. People are less willing to pay more for a future stream of earnings as the Fed has been raising interest rates. Number 2, earnings headwinds are out there. 2022 earnings are going to be not bad, up 8%, but that's closer in line to the historic norm of 6 to 8%, way down from 47% in 2021. And more importantly, Q1 and Q2 estimates, which is what we care about, aren't really rising anymore. So today, for example, for the first quarter, estimates are ranging from around up 7%. Now, just a few weeks ago, they were closer to the 8% overall return for the market expected. So the numbers aren't going up. Every month last year, those estimates were actually rising. So this is a change we haven't seen in a while. Why aren't the estimates rising? Well, there's a lot of confusion about exactly how much the Fed is going to raise rates at this point, and even about the course of the overall virus. There's another sign here that things are getting cautious. This earnings season is not quite as full of the upside surprises as we saw in the prior year. So, for example, right now, look at the number here, 65 companies reporting 80% are beating. That's less than before, and the average beat is only 8.5%. Still not bad, but it's half of what it was last year when we had very aggressive earnings beats. The other thing that's happening is there's more negative pre-announcements than usual. The big example, of course, there was Netflix. Kelly, I think the big thing here is the Fed action here now creating a secular change in the stock market. Just like the Fed created a secular change in 2009 and 2010 when they started pumping vast amounts of money into the economy. Now that they are withdrawing that, are they creating another secular change? And should we start expecting subpar returns from the stock market going forward? Kelly?
All right. And Stephanie, on that note, why have we had so many poor earnings, I would say, reports? It's really the stock responses so far.
Yeah, I think it's early on, though. I think we've only had about 10% of the S&P 500 companies report earnings. And quite frankly, I've been actually positive on the banks as well as the energy stocks. And in fact, I think that the energy stocks has been surprising because they actually are talking about super cycle, and this is oil services companies, because they have solid top line growth. They've been restructuring, so the margins are staying firm, and now they have pricing power. On the banks, they've actually done quite well. Not all of them, but I would be buying Bank of America, Wells Fargo, and Morgan Stanley today, right here, given the valuations and the reports that they put in. But we do have some issues to deal with. Bob's spot on in terms of not getting multiple expansion. I don't expect it, but I go back to who has pricing power, who's done a good job at restructuring and cost cutting and that sort of thing, and we'll see decent top line growth. So I actually am a little bit more optimistic. I think you're going to see 11 or 12% earnings growth. And I think that's good enough, especially since you've seen some of these stocks come down quite substantially. But those two sectors, so far, so good.